So I came across this article the other day about the top 50 assets held by Robinhood users in September, and to be honest, initially when I finished the article, I thought nothing of it, but as I went away and started thinking more and more on it, I had to do some further research, and what I found, honestly, it's really shocking. So I did have some initial concerns on this article about the top 50 assets held by users on Robinhood, so I did what everybody should do. I went away, I built an Excel to confirm my data. And yes, the data from this Excel did nothing but enforce my concerns with the top 50 assets held. I genuinely feel with what I found here that Robinhood users could be heading down a path of no return, and with the current stock market and the way it's going, this genuinely could be the last chance to save your investing career, especially if you're a user on Robinhood. But if you are a Robinhood user, don't worry. At the end of this video, I'm going to give you some tips on how you can lower your risk and exposure and make sure you don't fall into this massive trap that I feel most Robinhood users are clearly falling into. But as always, before we move on, I have to say this or the YouTube gods will punish me. Do everything in your power. Make sure that like button is turned blue. And if you want to join myself and other investors who are like-minded, sign up with eToro on the pinned comment, sign up deposit, make a trade, and you do indeed get lifetime access to our shared chat room. Now, if you've been living under a rock and you have no clue what Robinhood is, very briefly, Robinhood is a free trading platform where new investors can download an app and basically start investing like the boy old Warren Buffett. But it's not all sunshine and rainbows. Recently, Robinhood has come under scrutiny for the way they route their orders, for limiting trading, and also leverage on certain stocks, some of which are also on this list. But they did revolutionize investing, making the new smaller investors have a chance of beating Wall Street. They basically gamified investing. If you signed up, you span a wheel and you won a random stock. Gamifying investing. Ingenious if you think about it. But Robinhood is more than just a free broker. It actually does share a lot of its data, and you can go and see what clients are actually holding as time goes by. And if we look at September 2021, the top 50 held assets in Robinhood, this is what leads to my concern, because some of these stocks and assets, well, let's just say they're quite risky. In fact, majority of them are. Now, right off the bat, out of these 50, 2 of them are ETFs, and this is a good sign. An ETF is an exchange-traded fund, and an ETF, in its nutshell, was designed to help novice investors and people who do not have much time to participate in the market in a cost-effective manner and, in theory, match the stock market returns. If the stock market does 10% a year and you buy a SPY ETF, you should also make roughly 10% a year. It's a simple way of investing, and it has been deemed popular with more successful traders. But now, with Robinhood and other competitors like it, people seem to be, well, clearly are, shying away from ETFs. I was really shocked that there was only 2 out of the top 50 assets held, with 2 of them were ETFs, and actually they were ranked 39 and 40 out of this top list. And if you think 90+% of retail investors do eventually lose money, you can sort of see why. People are thinking they're the new Warren Buffett. Newsflash, you're not, especially if you're watching stuff on YouTube. I mean, Warren Buffett probably doesn't even know what YouTube is, and of course I'm joking there, but my point is a lot of people who use Robinhood think they have a chance of beating the market, and the long-term reality is you actually don't. You really should be reconsidering having more ETF exposure if we basket these 50 assets together. And I really was shocked at this, that the top 50 held, number 39 and 40 were actually ETFs, and the rest, well, we'll talk about the rest in a second. But given the fact that ETFs are designed to sort of match the market or match their sector, it is concerning. It really is right off the bat concerning that there's not that much exposure for new investors. I mean, Robinhood really is a platform for novice and new investors, and seems a lot of people think they are Warren Buffett, Charlie Munger, and probably a lot of these people don't even know who Charlie Munger is. But still, a lot of people seem to think they can beat the market consistently over a long time. It's been proven time and time again. It's actually really damn hard to do, especially if you're looking at YOLO AMC. So the second thing that I found really concerning with this article and this data was when I built my Excel, I looked at this. I mean, I knew off the bat that most of these companies were not really in great financial stead, and I'll be honest, it looked like a lot of people are gambling. I mean, I think that's what Robinhood has turned into. It's basically an online casino for people to pump up hype stocks. And if you don't like that mentality, that's cool. Unsubscribe and I'll see you later, or maybe never. But the simple fact of the matter is, there's a lot of new investors coming into the market and pumping up stocks with crazy valuations that don't even make sense. And I'll come onto that right now. I looked at 3 criteria on this Excel. I wanted to keep it very, very simple for you. 3 criteria for these 50 assets. Now, I'm going to narrow that down to 48 because I did say 2 of them are ETFs, so I don't think it's that relevant. But let's have a little look at the criteria in more depth. The first thing was the PE ratio, the price to earnings. If you don't know what that means, basically a PE ratio is the price of the stock compared to the earnings. And typically, the lower the PE, in theory, the better value it is. Now, it's not an exact science, but the average historical market is around about 20-ish%. So as a rule of thumb, anything under 25 typically could be argued to be good value in terms of their earnings. So really, I went ahead and I collected all these companies' PE ratios. But the downside with this method is, if you're not a profitable company, you can't have a PE ratio. It's mathematically impossible. So that leads me on to the second criteria. Is the company even profitable? Because remember, these are the top 50 assets held. So you think that majority of them would be profitable, because it's okay having 10% into a gambling or speculation, but you'd think that maybe, well, that would be 5 stocks. Let's see if there's more than 5. Well, spoiler alert. Way more than 5 are unprofitable in this top 50 list. But then that brings me on to the third criteria, probably one of the most important, which is dilution. Now, I know there's going to be some fanboys in the comments saying you don't understand what dilution is, or you don't understand a growth company. But the simple fact of the matter is, dilution is never good if you're a current shareholder. Now, dilution for a company is useful because they need to raise capital to build plants or do whatever it is they're doing in the green sector these days, or even in the EV sector. That's cool. Look at AMC Cinemas. I mean, they're on this list. You really need to see that. But AMC Cinemas as diluted shareholders a hell of a lot. And what that means is, in very basic terms, is if you owned a share of a company that is listed with only 10, you own 1 share of the total 10, you own 10% of said company. If they double their share count, they sell them to other investors at the market to raise capital, and let's say they sell another 10. There's now 20 shares on the market, you still own 1. Basically, you now own half of the company in percentage terms of what you did before. So that means not only does the company need more volume to go up, but also you evidently own less of that company's profit. Remember, when you buy a stock, you're not just buying a random, couple of letters with a chart. You're buying an actual business, and you need to think about that. Dilution is not a good thing. But in the other side, you can buy a company like Apple, also on this list, who are buying back shares, which means over time, you actually own more of said company. But looking at this data, here's the concern in simple facts. We have 21 profitable companies out of 48. That's quite alarming. Remember, this is what Robinhood users see as the top 50 held assets out there. That's the way you have to look at this. This is the top 50 held assets, and 21 of them are profitable. That's horrific. There's no other way of describing it. That is damn horrific. And even if you took the best companies from this list, the 21 that are profitable, let's say, the safer investment, let's call it, and, remember the PE ratio I told you about, where, 20 is the average, the lower the better, closer to 1, typically the better it is value-wise. If you added up these 21 companies in terms of PE and got the average PE is still damn horrifically high, at an average of 67.09. That's overvalued. So that means if you evenly bought the profitable companies and spread it out, it's not good value. It's dangerous. That's all it is. It's just setting yourself up for a bit of pain. You're not buying value, you're buying hype, even with the profitable companies as a whole. And I know there's probably going to be some person sat there thinking, well, yeah, I just won't buy, Tesla, which has a high PE, or I won't buy some of the other companies that have high PEs. I'll buy Apple. I'll buy some of the safer stocks, Microsoft maybe. But the simple fact of the matter is, if you go on PE on that ratio, they're also overvalued. Majority of them, they're all overvalued. So you just need to sort of be careful because even with this mentality, you're probably going to mess up sooner or later because you're buying a stock from this list in general. It's not the way to do value investing. So taking out the 21 stocks that are profitable out of the 48, we now then have 27 which are not profitable. 27 that you can't even calculate a PE. And again, remember, these are the top 50 assets held at Robinhood in September. But the biggest shock to me here, and seriously, this is damn scary, out of the top 50 assets, the top 48 stocks, should I say, held at Robinhood in September, 38 of them are diluting you over the last 5 years. And I want to clarify the dilution here because I didn't address it properly earlier. With the way I calculate dilution is I go over a 5-year period and see how many shares they had then and how many shares they had now, and then look at the difference. It's pretty horrific. 38 of them out of the 48 are diluting you over a 5-year period. And if we look at the companies that are diluting you the most, some of these companies have diluted you way more than 50%, but 16 of these 48 companies have diluted you over 5 years more than 50%. This is the sign of a struggling company. I know, growing company, growth company, whatever you want to call it, but believe it or not, that is still a struggling company because they are needing to raise capital from your pocket. That's the simple fact of the matter is they're taking capital from you or your friend's pocket or whoever else buys them shares. That's the basic essence. They have to sell stock to an investor or even raise debt to fund their thing. That doesn't sound like a well-structured company, does it? Let's be honest here. And out of these 48 stocks, how many are doing the good thing? How many are buying back shares and rewarding investors? Well, yeah, we did say 21 were profitable, but only 9 are buying back shares in any way, shape, or form. That's, again, not a good number. I mean, okay, the 9 companies that are buying back shares, some of them are actually all right. I'll give you that. But, in fact, some of them are actually great. I mean, you've got Apple in there, of course. But the point I'm trying to make here is this is 9 out of the top 50 holdings at Robinhood. That's not a great sign. Now, I'm not saying there's anything really wrong individually with any of the companies here, because I'll get onto that in a second. But what I am saying is, if you look at the average user of Robinhood, and these are the 50 held assets, and only 9 of them are buying back shares, and 16 of them are diluting you more than 50%, then it just sort of sums up what the new investor is doing. It's gambling. It's gambling, for God's sake. That's all it can be. And eventually, the market will correct. It's going to correct. There's going to be a crash. Eventually, it might not be this year, might not be next year, but eventually it's going to crash and these companies will get hit the hardest. If you don't believe me, look at what happened in the tech bubble. Everybody thought if you're not buying tech, you're basically a loser and you live in your mum's basement. But if you look at it logically, out of them tech stocks that crashed in the dot-com bubble, which everybody's seen coming if you ask anybody on Wall Street these days, there's not many around. I mean, Amazon fell 90% in that tech crash. Every company fell. Cisco, a huge worldwide name, Cisco Systems, is still not at its levels it was before the dot-com bubble. How many years ago was that? We're like 30 years ago or something. Think about it. That's a huge company that still has not fully recovered, and it's not the only one. And if you're sat there thinking, yes, but you'd pick Amazon that fell 90%, I'm sorry, but you're absolutely delusional. So what are the key takeaways here? Well, firstly, I think a lot of new investors are looking for the new Cathie Wood innovation stocks sort of mentality, which is fine in a way if you are not going all in. But given the fact of the data that these are the top 50 holdings, I mean, think about it. Majority of people opening a Robinhood account there's no hedge funds opening a Robinhood account. It's people who are starting investing, people who have a couple of $1,000, and really that's all they have. And I don't mean that in a bad or derogatory way. I just mean there's no one with $100 million opening a Robinhood account, because there's no such thing as free trading. But the simple fact of the matter is these people combined together make a hell of a lot of money in a pool like the assets held at Robinhood. But these are the top assets held. A majority of them are speculation plays. It's not going to end well, guys. So I really think that if you are in Robinhood or you're in some of the stocks on the list here that you can see on screen, then I think that you really need to sort of reassess your situation, because don't think you're going to get out at the right point. Don't think you're going to sell a stock at the right point. Don't think you're going to buy the next Amazon in the next big .com style crash. Because reality is, look, you're on Robinhood, you're on even eToro, you're on other companies of the sort. You're not Warren Buffett because you're watching a YouTube video of a good-looking guy with a beard. I really don't want anyone to lose money here. I really don't, and I hope this message gets across to you. If you have speculation plays, that's cool, but don't be all in speculation plays is what I'm trying to get across here. Make sure you do your discounted cash flows. Make sure you keep checking your filings, see if they're diluting you, and if they are, don't be afraid to get out. Don't be afraid to lock in gains and look for something more long term. A lot of people, I feel right now, are looking at companies like Tesla thinking it's gonna go up to $100,000 a share, God knows how much, and I'm gonna become a millionaire. But reality is, that's it. Yeah, it might. It might. It's probably not, but it might. Great. I might turn into a unicorn. It's not gonna happen. Look, just be safe out there. That's what I'm trying to get across here. Now, if you're watching this far, I do hope it sort of rubs off on you and you understand why you should buy value, not buy hype, and why this is really concerning, because you shouldn't be following the herd. If it rubs on you the right way, drop the code word down below, which is eToro is better than Robinhood. And if you want to know how to sort of value stocks better, here's 3 random stocks that I valued recently, and I had to go and buy one of them. So if you want to go and see me go through a bit of pain, check out that video up there. That's it from me. Take care. Peace.